Hello, everybody. Welcome to today's webinar on the topic of behavioral finance, women and wealth. My name is David Stankwitz. I'm staff here at the IEEE Operations Center in New Jersey, and I'm joined today by Cheryl Young of Young & Associates at Morgan Stanley. Cheryl is going to deliver today's session for you. I just wanted to start off by thanking everybody for joining today. I want to thank the IEEE Women in Engineering International Leadership Conference, of which this virtual session is a part of. Before Cheryl actually takes the mic and begins her presentation, I just want to go over a few housekeeping items and let you know how you can participate in today's session. So if you have joined today's webinar listening through your computer's speaker system, also known as Voice over IP, this means that you'll be able to hear Cheryl's presentation without actually dialing in using your telephone. And because we would like to make this as interactive a session as possible, we're going to leave about 15 minutes at the back of the presentation for a Q&A. We're going to take questions from the audience through two mechanisms. So if you'd like, you can use the WebEx chat feature. Simply type your question to myself, the host, David Stankwitz, and click send. And if you'd like to actually follow us on social media, you can join the conversation there by tweeting using the hashtag WIE-LEAD. That's hashtag WIE-ILC. And finally, I'd like to just let everybody know that we are going to be recording today's session. So if you miss any portion of Cheryl Young's presentation, or you'd just like to go back and rewatch it a second time because you enjoyed it so much, you can do that. And we're going to post this video up on the IEEE Women in Engineering YouTube channel in the coming days. So without further ado, I will kick it over to Cheryl.
Thank you, David. I am excited to be here. I just ran the Boston Marathon on Monday, so it's great doing this virtually because I don't have to put on heels, which I usually would wear presenting. So I appreciate the virtual session as well, and encourage anybody who has questions to ask them at the end or give us feedback on Twitter. My job as a wealth advisor is really to help clients in achieving financial goals. And I help them focus on certain elements, including defining goals, putting together a clear and complete financial plan, constructing portfolios that optimize risk, weighted returns, and really helping people stay objective and focused. And these are all elements that are critical for financial success. I've been coaching clients and teaching financial seminars for almost 18 years and am recognized in the top 1% across all firms by both Barron's and Financial Times. In fact, made the Barron's top 100 list for female advisors in the nation last year. I was number 64. So hopefully I have a few things that will help you in your financial journey as you take the time out of your day-to-day, learn how to be a better investor. This session is actually one of my favorite ones to teach at different companies and to my clients as well, because it focuses on an area that really is, by many people, ignored, and that is the area of behavioral finance. And I feel that it is an area that is very important, and yet a lot of advisors aren't talking about it. And I'll define here in just a second what behavioral finance is. So first, I'm going to play a little game, and I want everyone to tweet their answers. And again, that is to hashtag WIE-ILC. So I'm going to have you give me your answers. And I know most of you are engineers or working in the engineering profession because this is the IEEE conference. So let's see how you do on the question. First question, I have a ball and a bat that combined cost $1.10. If the bat costs $1, how much then is the ball? And then give you guys just a couple minutes to answer that. David, do you have any responses there yet? All right. So the most common response is 10 cents. How many of you wrote down 10 cents? 10 cents would actually be incorrect. The answer is, of course, if you think about the math, 5 cents because the bat costs $1 more than the ball. So if it's $1 more, $1.05 would be exactly $1 more than 5 cents. But the most common answer, and every time I've done the session, is 10 cents. And this is a perfect example of what I would call a mental heuristic or an accounting error. Our mind uses these shortcuts and has some legitimate reasons for these shortcuts. But understanding part of these mental shortcuts, I think, is very important in understanding how you think about your financial strategies. Not to pick on your math skills, it's about really understanding some of the common emotions, misconceptions, and errors in logic that all of us do day to day, and to think about how we can avoid them. So that's what I'm going to really focus on, is different kinds of client emotions, what I see in reality in terms of the market, and so that you can hopefully gain a better understanding of how to think about your own financial planning. I find that women especially have a hard time juggling and balancing their lives. We're all mothers, sisters, grandmothers, daughters, wives, and we take a lot on and often have a hard time saying no. And because of that, we end up relying, as people, men do this too, on a lot of shortcuts to help us get through the day. So please understand that I'm not picking on any of you. A lot of this is just about basic survival in getting through your day. But it's important to understand your own background. And if you think about money, think about how you were raised, what your parents' associations with money were, what your basic fears are, how you react when the markets go up, when the markets go down. Do you look at your finances? Do you avoid it altogether? Do you put your head in the ground and hide from it? And if you don't understand these basic behaviors, it's going to be very difficult, regardless of how well you've outlined your plan, to really do a good job maintaining that plan and becoming more successful. So today's session is going to identify some of these, what are called mental heuristics, and help you get through them. So we track in our industry money flows quite closely, and we know where people are investing. We know when money is going to stocks, going to bonds, going to cash. I know for a fact cash reached an all-time peak in terms of overall market cap in March 2009 when the stock market was an all-time bottom. In fact, if you drew a chart out between cash and the stock market over long periods of time, you will find that every single time the stock market has dropped, cash has been at or close to an all-time peak. And every time the market's rallied, cash tends to be very low. So we know the fear and greed cycle is very real, and it affects most people in the world. So let's talk about whether or not you are a rational investor. If you look at the last 10 years, we know that the average equity investor has made about 4.25%, and that is compared to an average per annum of about 8.21 from the S&P 500. Bond investors, ironically, who tend to be more conservative, they've done even worse. The average fixed income investor has made less than 1% in the last 10 years on average, and yet the Barclays Aggregate Bond Index has done 6.34. So why this huge difference in performance between investors and the indexes? Behavioral finance really helps answer some of these questions. And just to give you some background on behavioral finance, it draws on finance, psychology, and sociology to help explain some of these common investor mistakes. In fact, probably the most well-known name in our industry around behavioral finance would be Daniel Kahneman. He won the Nobel Prize on behavioral finance back in 2002, so fairly recently. And it's an area of study that has only been really embraced by the financial community in the last decade. If you follow things like modern portfolio theory or asset allocation, Markowitz and Sharpe, who are amazing and were really the forefathers of asset allocation theories, the Nobel Prize that was awarded to them was based on research done in the 1950s. So this is still considered by the investing community a much more recent area of study, and it really evaluates some of the emotional basis for making decisions, some of the perceptual basis for making decisions, and just the overall intellectual processes that lead to faulty judgments along the way. So this field of study is one I like to think about when you turn on CNBC. If any of you watch CNBC, not to pick on them, I've been promoted on CNBC, love them, but when we look at the news, a lot of their job, you have to really understand it's about getting people excited about something. If it's really boring, why are you going to watch the program? So if you logged on and had the same day-to-day analyst comments, you wouldn't log on. And I think a big part of the problem that we see in the investment community, which a lot of engineers will really relate to, is this concept of noise versus signal. The market is strong, and sometimes we get these calls the same day. Someone else will say the market is weak, profits are up, profits are down. Nothing is boring. It's got to be full of a lot of excitement and call to action, and there's always something to do. I'm going to pick on Jim Cramer for just a second, and he has had some great ideas, but if you think about his show, he has to promote a stock, whether or not you're going to buy or sell it, in many stocks every single day. How many people would really do well if they were trading these stocks every single day? And the fact of the matter is, people who tend to go in and out of the market tend to have the worst performance. In fact, the optimal performance, and this is done by a study done at Berkeley, Hospital Business, was that people who went in and rebalanced their portfolios 3 to 4 times a year max had the optimal performance compared to people who went in daily or weekly or certainly by the minute. So separating out the signal from the noise can be very difficult, and I think it has gotten much more difficult with the technology that we have today compared to even 10, 15 years ago. You know, there's so much information on the internet. You have radio while you're driving in your car. You have your magazines and your newspapers while you're sitting waiting to get your hair done. You have your friends who have their stocks that were their best pick that worked really well for them recently, but doesn't mean it's going to work well going forward. And so there's a lot of noise out there, and it's really difficult sometimes for people to separate out what the true signal is and how to make out reality of what you should do amongst all the noise. It's a big part of my job on a day-to-day basis in helping clients manage their portfolios. In fact, interestingly enough, Fidelity has done lots of studies on this, and there was a study done fairly recently on 401k accounts that looked at the more investment options one had, the less likely were actually going to use or get participants to use the 401k. So 401ks that had only 2 options, 2 funds to choose from, had a 75% participation rate among employees. If you look at 401k plans that offer 50 choices, they only had a 63% rate of usage by employees. And so we know choice overload actually makes it more difficult for people to make a decision and to take action. Emotions taking over is a common thing that I see often. Markets have been a little bit more calm in the last few years, but I know in 2008 there were certainly a lot of people who were talking off the cliff. And in years that are very good, like in 2013, which is a phenomenal year for the S&P, for example, you get people who just started investing and they become very overconfident because they had a great year, but they've only been doing a year, and the market did well too, so was it spin with the market? And as humans, we tend to give ourselves credit, and this is just a well-known fact among psychologists, we tend to give ourselves credit for things we've done well, and we tend to blame others when things don't go the way we want them to. And so overconfidence is a common problem that we see with especially new investors, but even sometimes with investors that have been doing it a very long time. Sometimes people get lucky and they take credit for being wisest in the market versus getting lucky, where then they pick the one stock that's bad, and well, how could they have known that that deal was going to have an affair with their secretary, right? So overconfidence is something to really consider. Loss aversion since 2008, I would say, has probably more of a problem among people. In fact, if you looked at money flows, money was flowing more heavily into bonds. Even though bonds have performed half that of stocks in the last 5 years, at about a 3-to-1 ratio if you took the 5-year average. In fact, that did not shift till the end of 2013, where we had the markets more than double from where they were at the lows in 2009. So that loss aversion and that avoidance and I don't want to lose money really kept people paralyzed by fear in terms of getting back into the market. Interestingly enough, if you look at the S&P 500 and charted it back to the very peak of the market in 2007 before that 2008 crash, it is up, including dividends, more than 50%. And so you're looking at going back to roughly about October of 2007. It was October 14th of 2007. And graphing that out till now, you would see that even though you have experienced a 57% loss, peak to trough from 2007 to the bottom of the market in 2009 on March 9th, you would have seen very nice returns and better returns in the S&P 500 than you would have participated in if you had done only bonds. In real estate, even, real estate still has not as an, we've still not as a nation recovered quite to the peak of the market in 2007, although getting close finally. But the stock market's been back up and beyond that for a couple of years, and certainly better than cash. And so I hear often in my job, well, I don't want to take a chance on losing money, so I'll put in cash. What's the problem with that? Inflation. Cash is guaranteed to lose money. And so it feels safe, but most people cannot achieve a long-term retirement strategy, especially when people are retiring at 50, 60, which is common in Silicon Valley, where I live. I have a lot of clients retiring even earlier than that. But if you think about the longevity that we now face, people tend to live longer because technology has improved dramatically. And the medical community feels that the statistics are right now that you have about a 1 in 2 ratio hitting your mid-90s. And assuming I have a mostly female audience, we tend to live longer than men, and we really need money to be working for us and staying ahead of inflation. So loss aversion is a big emotional problem that people don't understand the impact of real returns and don't understand the impact of inflation. We'll talk about more of that in just a second. Real speaking, I tend to say this less if I had to generalize with my female clients and my male clients. In fact, Warren Buffett did a study a couple of years ago that showed that female financial advisors actually have outperformed their male counterparts in terms of actual returns by enough statistical relevance that he published a paper on it. So you can look that up and go Google it. But part of it comes down to this thrill-seeking mentality. And it's the same mentality that has built all the big buildings in Vegas. You know, I want to go put my money on roulette. It's terrible odds, but it's really fun when I win. And so thrill-seeking is a problem for a lot of investors that they can't maintain a disciplined portfolio because they really want these big wins, and they end up losing everything they built up because they're constantly chasing returns and constantly going after big wins. And the final emotion that I see quite a lot is the fear. And this is, in my opinion, the most dangerous emotion of all, and again, paralyzes people from taking action and reaching their financial goals. So I love this chart because I actually was part of a panel. Again, this was done at Berkeley, and they gave us all little beepers in our hands, and so we had to click. And we were given a stock, and we were told, the stock is going to open at $10 trading, and we're watching, quote unquote, real time while the stock is trading, and deciding where we want to sell the stock. So they're opening at 10, we want to decide where to sell the stock, and you can see in the room people are waiting and waiting, they don't want to click yet, and they go through this roller coaster. We start with optimism. Okay, at 10, it's going to go to 12. We're excited. There's the thrill of this new investment that we just discovered. We've done our research. It's a great biotech company, whatever. It's going to get FDA approval. And then you start seeing, I can't believe I'm so stupid. Maybe I should have sold. So this anxiety starts to set in when the stock starts pulling back in price. So it goes up from 10, 12, 14, euphoria is up to 16, goes back to 14. We're feeling a little anxious. Goes back to 13. Now I'm in denial. It's going to come back. Gets back to 11 and 10, and now it's going down to 9. So you see panic set in. And it's bouncing left in room because it's right down here people start really clicking the button. And selling, when we have this panic and this panicky kind of reaction emotionally, and then the stock comes back up, which of course we don't know. This is a simulation. We don't know what the stock's going to do. But by the time we get back to that point of the stock getting back to 10, most people in the room have already sold, and very few people actually hit the peak. And it's kind of a fun simulation because really we see that people have a very difficult time deciding when to sell. And this is the biggest problem I see with overconfidence. I have a client, and he's very smart. He has been a very successful CEO, sold companies, brought companies public, and he subscribes to no less than 21 different financial newspapers. You know, so he gets these emails every day with all this information, and he's just so confident on the stock, but nothing's telling him when to sell. And so he has for years, you know, before coming to my office, underperformed the markets because he keeps chasing these hot stocks and trying to beat the markets and not being disciplined. And he goes through this emotional roller coaster but never sells. So he brings his portfolio over. I'm looking at it. He's got a couple big winners, you know, a couple stocks that have doubled, tripled, but he's got a lot more in the red, down 58%. Well, why did you sell this? Oh, it's going to come back, and here's all the reasons I think it's going to come back. And well, would you buy this stock today? No, I wouldn't buy it today, but I'm going to wait for it to come back before I sell it. Well, why would you hold this stock if you don't believe it anymore? You know, we have these discussions, and this overconfidence, I think, can be very dangerous, and it leads to taking excessive risks and people buying and owning stocks without understanding really what they're buying and why they're buying it. And I love this. Again, you could tweet your response so Dave and I could see it. But this overconfidence tends to lead to, you know, in general, people think that they are better investors than they really are. Ironically and interestingly enough, when you pull women versus men are very confident in their financial investing skills, much more so than women. In fact, about 3x the level of men feel confident compared to their female counterparts. Interestingly enough, when given, you know, some financial tests of their financial acumen, even though only 17% of all women report they feel very, very savvy with their investments, they are within 1% of the actual results as their male counterparts. So we actually rank better than we think we do. So this, again, tends to be almost more of a male phenomenon than a female phenomenon. And when polled, you know, we ask the audience, you know, how many of you out there, how many of you think you drive better? You really pay attention. You're not texting, I hope, when you're on the road, but how many of you out there driving and you think, I really have above average driving skills? 93% of you answer, I'm above average. Well, the definition of average is this is not possible, right? Only 50% of you really can be above average drivers. That's the definition of average. And so it's not possible to have 93% of us being better drivers than we really are. And we see the same problems in finance. So watch out for overconfidence. The second one is this tendency to really avert losses. And if I give you a wager of let's flip a coin, if it's heads, you lose $100, and if it's tails, you win $100, very few people will take this bet. The last time I taught this class where I had a live audience, I had about 20% of the people in the room raise their hands willing to take this bet. So very few people were willing to take this bet. So what the studies show us is that you have to have about twice the gain as the loss in order to really sign up for this gamble. So people tend to really stay away from things they feel like they can lose money on, but then they're overconfident in things they can make money on. So it can lead to disastrous results. Again, the consequences are you do nothing and you miss great opportunities. How many people did not get back into the markets until 2011, 2012? We know, the studies show how much cash was still in play in 2009, 10, 11, 12. And most people really did not start shifting back into more stock portfolios until 2013. So 4 years, and the stock market had already doubled by then. People take imprudent risks to make up for loss. This is something I see all the time. Okay, well, I lost money. Now I've got to take a lot of risk to get back up. And the common way of thinking about this is if you started off with $1 million, let's say you go down 50%. We have the 2008 situation, and you're down to $500,000. Well, you don't need 50% to get back to $1 million. You need 100% return. And so people start taking excessive risks to catch up. And then, of course, as we already discussed, holding on to that loser too long. this goes back to what I was just talking about. You know, you have the clicker, but we see what people do in real life too, and so there's a lot of academic studies done on this. You've investor number one, they bought this stock that I already mentioned at $10. Investor two, so, you know, my good friend who's across the hall is saying, Cheryl's made some money on the stock, and she bought it at 10, now it's at 20. I wish I'd jumped in, and I didn't, but, you know, I'm going to go ahead and jump in. So they bought it at 20, I bought it at 10. And the stock goes up to 30. Neither one of us sell, right? And the stock pulls back down to 15. Investor one is at a gain, right? I bought at 10, I'm at 15. I'm still at 50%, I'm still pretty happy. Investor two, who is chasing returns, however, who's going to feel worse? And we know, I'm sorry, skip that slide. We know that investor two is the one who actually feels worse. And so they would regret the loss more if they sell, which means they do nothing and they keep writing it out to avoid the reality of losing money. When in fact, probably a lot of these situations, they should have gone ahead and trimmed that stock or taken it completely off the table. Like I said, thrill seeking, I see a little bit less with my female clients. Let me move on to fear because this is a big one. Fear, if you think about fear, it has physical effects on our bodies. Our heart rate goes up, our breathing changes. The primal core of our brain, the amygdala, you know, if you look at the actual functioning of the brain, it's very fascinating what happens. The most primitive part of your brain actually starts kicking in, and blood flow gets decreased to your cerebral cortex where we're making complex decisions. And there's a rationale for this. You know, if you are confronted by a snake when you're hiking and you need to get out of the way because he's rattling his little tail, you got to move. You need to not be overanalyzing the situation and thinking too much. You need to move fast. And so it's very important that we have this very primal response in a lot of situations. We see this driving. We see this in any situation where there's physical danger to us. Unfortunately, we also see it in the way people invest, and we see it in stocks. And so we know if we hooked you up with all the little biofeedback mechanisms we could and looked at what was going on during a market downturn like a 2008 scenario, we know that people stop making good decisions because fear overtakes them. And the danger is panic selling. You look at how many people were selling right at the market bottom, investment paralysis. And so the best defense is to really have a plan and understand what your time frame is. I never would encourage anyone to invest in stocks with a year time frame. Your chance of losing money is about 50%. Now, that means your chance of making money is about 50% as well. But a year, in my opinion, is too short to be buying stocks. So understand when you need that money. Think about what I said earlier. That market in 2007 until now is up about 50%. How long has it been? It's been about 7.5 years. Well, the market recovered after about 5 years, which was, by the way, a 4 sigma event to have the downturn we had in 2008. The last time we saw a market that had was really 1929. So hopefully in our lifetimes we have it out of our system. Statistically, it should never happen again. But as bad as it got, we were still better off taking the stocks, and it was really hard for people to come to terms with that. And so making a plan and investing in stocks should be about having long enough for markets to go through their cycles and correct, and not needing that money short-term for gambling and trying to chase returns. And if you know that the money is not needed for 5, 10, 15, even 20 years, you probably should be, especially if it's 15, 20 years, you should probably be looking at stocks, especially where bonds are right now. We're at the lowest yield curve I've ever seen. I mean, 10-year treasuries are paying 1.7%. It's pretty bad out there trying to make money, certainly in cash, maybe you're getting 0.7, and bonds, you know, you're not getting paid well. You're maybe making 2 to 3% over on your bonds if you're using a mixed portfolio that includes corporate bonds and not just treasuries. So stocks are a great tool, but you need to have enough time, and you need to be able to get rid of that emotional response. So let's talk a little bit about perception, and this is a fun area. My background is, it's in my bio. If you look at my bio, which is on the second page of this slide deck, and I think on the IEEE website, I started off college as an engineering student. I was 16 years old. My dad was an engineer. I have 5 older brothers. They're all engineers. I've had total geek as a kid. I did math contests in my spare time, and so I had a lot of math, a lot of science, and everybody in my family was studying engineering, so I studied engineering. I hated it. Good for you guys. I'm so glad we can do it out there. But it just wasn't what I was passionate about. And I really loved the brain and how we analyze things and how we, just came to terms with things. And so I wanted to go into neurology. And so my degree was actually in psychology, and then I went to grad school in biochemistry and was planning on being a neurologist when I started playing around with stocks and really found that people do not look at their stocks in a holistic manner. In fact, what I found in my investment club days was that everyone was chasing returns. We're all trying to figure out the hot stock. No one was thinking about tax impact. No one was thinking about inflation. No one was thinking about when you needed the money. There's no creation of buckets or strategies. It was just, throw a dart. And I don't know if you remember the studies back in the 90s, but the monkeys would throw darts on CNBC, and they would most of the time pick stocks that would beat the portfolio manager's returns. And so everybody was doing great back in the 90s. I mean, it was a very easy market to make money on for almost a decade. I mean, we had a little bit of a rumble in 1998, but it wasn't that, and we came very quickly. And then 2000 hit, 2001, 2002. You guys all probably remember the dot-com crash. I certainly remember. I was fairly new. I started studying for my Series 7 in 1997 and started off, full force in 1998. I had a 78% return my first year. I was ecstatic. I thought it was a wizard. And then we got this huge market correction. And so it's interesting because looking back at my background, by the way, I never regret not finishing med school, best decision in my life, but I laugh all the time with clients because while they look to me for my math skills, I really feel like those studies in psychology were just as important in understanding and identifying ways to help clients. So this goes back to some of my basic psychology classes. I realize it's been almost 20 years, but going back to some of the psychology classes, anchoring, hindsight bias, prejudice, framing, pattern recognition. Let's talk about some of these. Anchoring is one of my favorite. And again, if you want to tweet this, I'd love to see some of your responses, or just write this down and think about it. So, everyone in the audience, we're going to take a second. I want you to write down the last 4 digits of your cell phone number. Okay, I'm being presumptuous that you all have a cell phone number. If you don't, any phone will do, your home phone, your office phone, whatever, last 4 digits of that number. Okay, so my last 4 digits are 4574. I'll just use me as the guinea pig here. Next question, okay? I want you to think about, do not Google this, okay? You're paying attention to what's going on here. Don't get online and Google. How many doctors do you think, given your best guess, live, and by that I mean medical doctors, live in the city of London, London, England, not Texas? All right? So I would love to know your answers, but since this isn't a live audience, hopefully a few of you will have played the game well. And the last time I taught this session, one of my clients had a phone number that was 7810, and their answer was 8,000 doctors. I had another client who had a phone number that ended in 2537, and her answer was about 3,000 doctors. Interestingly enough, over 2/3 of people, when polled in this manner, round up right around their phone number the number of doctors that live in the city of London. Okay, so what possibly does the number of doctors living in the city of London have to do with your phone number? Absolutely nothing, right? Nothing. This is called anchoring. Once we hear something, it's very difficult to let that piece of information go and to think about the actual answer or what a rational answer would be. And we see this all the time. And companies recognize this. They use it in marketing, trust me. And they use it when trying to think about how they're going to announce their quarterly results, that you have the number that you're anchored on before they give you the bad news. So this is actually a very well-recognized phenomenon that we all in this industry understand. And trust me, companies take advantage of this and realize we have this mental gap, if you will, in our mental heuristics. So anchoring is a fun one. Let's talk a little bit about some of the other perceptions. So I just threw up on the screen. Oh, makes my eyes burn. Don't look at that. How many of you see gray dots on this? Look at it. Did the gray dots start moving? So this is a slide deck. It's a PDF. I promise there's nothing moving on the screen. But when we look at it, the way our eyes process this information is that we see a gray dot going in and out of the screen, and there's no actual movement. And of course, we know that this is how back in the day cartoons were made, is this use of deception on our eyes. So again, you have to recognize, well, many of us have similar gaps in heuristics. Part of this is just normal, and we shouldn't beat ourselves up about it. We just need to understand them so we can make better decisions. So going back to this anchoring, you know, and if this was the information I gave you today in 2015, you know, you're a new client, you said, all right, give me two choices to invest. I'm saying, all right, investment A, you get a 15% annual return. The manager's been doing this 10 years, standard deviation is 19%. But it's a Morningstar 2-star ranked investment. Or I have investment B, which is only averaged 11.9 compared to 15.3. Manager's also been doing it 10 years. It's got standard deviation of 6%, but it's a Morningstar 5-star fund. Which do you pick? How do you make this decision, right? And what's interesting is it really depends on what's been happening recently. You would have seen in 2007, most people would have opted for option A and absolutely ignored the standard deviation of this investment. If you look at 2009, 10, 11, 12, 13, most clients were opting for investment B. I'd rather get less return on average and have a much lower standard deviation or amount of variation or volatility in my portfolio, and I'd rather have one that everyone else was really good about. Give me the higher ranked investment. I want one that has a stamp of approval, even though statistically there's actually no difference between a 3, a 4, and a 5-star Morningstar rated fund. Now, I will say there are enough statistics supporting that 1 and 2 stars are more likely to underperform in following years. But the difference between 3 and 5 stars, we cannot find any statistical relevance supporting the decision to use a 5-star fund versus a 3-star fund. So it's interesting because we hear all the news and have all the fear, and we change our investments because of this recency bias. My favorite, you know, I saw my brother a couple of weeks ago, so I'll pick on him. And he's an engineer, so if he's watching this, I apologize ahead of time. I'm 5 brother, so, you know, his reputation will stay safe because it could be any of them. But, you know, he was saying, you know, I knew when Apple did this last time I should have bought more, and I almost called you because I wanted to double down on Apple. And I was like, well, of course you knew, you know. Apple did enormous in the last 6 months, so everybody knew. If you knew, why didn't you buy it? So we tend to have this perfect hindsight bias of, you know, I thought about something for 1 minute, and now that's all I can think about. Now, he might have thought about 10 stocks the same day and not acted on any of them, right? But the only one he remembers in hindsight is this really great performing stock. And so I call this the Monday morning quarterback phenomenon, but we see this a lot with investors, and it's dangerous. If you sold a stock, made a gain, let go, move on, be happy. And don't believe that you're smart when you're only lucky, because sometimes it's just luck that gets us there. I want to make sure I keep an eye on time so I can leave enough room for questions. So I'm going to be wrapping up here in just a minute and start to take some questions from you. But, you know, we see this a lot, again, as an advisor. I see all the time. Someone will come into my office and say, you know, my parents lived through the Great Depression. They got really burned in this bond market. There's just no way I have any interest. I'll never have fixed income. But yet they're about to retire and they're 65 years old and they probably should have some fixed income in their portfolio. Or, you know, I want to only purchase investments that are within the top quartile. Well, how many money managers are in the top quartile every single year? I mean, the number who repeat that year over year over year are actually very, very low. So just because they were in the top quartile doesn't mean they will be the next year. You know, I invested in small caps and I'll never do that again. You know, so I hear this a lot. And what happens is people don't construct portfolios based on appropriate correlations or figuring out how to really mathematically weigh their positions. They're doing it based on gut. You know, I bought Apple because, or I bought Microsoft because, versus I put Apple in the portfolio because the fundamentals looked good, I understood the P ratios, I looked at it compared to the other positions in my portfolio. Apple's only been correlating with the S&P 500 30% of the time in the last 4 years, which is, by the way, true. And so I thought it was a good diversifier and has a dividend now and for the stock buyback. I mean, those are rational reasons to insert something in a portfolio. But we buy based on biases, and often, I see this a lot in Silicon Valley, often people buy what they know. Now, you know, Peter Lynch, who is one of my great mentors, you know, in the industry, he used to say things like, if you can't write it on a napkin, if it's not simply priced investment, probably good advice, by the way. And he also is a big proponent of investing in what you know. The problem is if you are an engineer and you understand technology, and you're only buying technology, you think about that dot-com crash and what happened to the NASDAQ, which only very recently, by the way, recovered to its all-time peak, back from 2000 till now, so it took 15 good years to recover. We know that people tend to underperform buying only what they know and not being broadly diversified. So if you understand technology, you probably need someone to help you insert things like healthcare and things like financial stocks and other stocks that are really going to lower your risk and improve your returns over longer periods of time. So very, very important to understand this one. And then framing. And again, remember, companies understand this. People who are in the advertising absolutely understand this. Your glass is half empty versus half full. Do you have a 50% chance of success? Oh, I want to invest in that. Oh, but it's 56% chance of not making money. And I don't know, maybe not, right? The common one, you see this in all the insurance ads. Buy your child. You love your child. Well, if you love your child, buy them insurance now while they're a baby. I mean, $3 a day. Don't you love your child enough for $3 a day? No one says it's $1,095 a year. $3 a day is a much more powerful amount to swallow. And so how we frame things is very, very important because it changes the outcome of our decisions. And this is one I see a lot, and I talk about clients. You look at a rate of return of a specific investment or a specific asset class. And I'll give you a common example. Let's say that you had a 10% average inflation, but a 12% return. Well, you only beat inflation by 2%. The 12% sounds great, but what was inflation? And if you think back in the 80s, we had stocks growing at 12, 13% a year, but inflation was above 10%. I mean, I had clients who bought houses at an 18% mortgage rate. So those numbers, if you remember back then, were real. Versus a high investment that is making, I'll use today's dollars because inflation is actually below 2% right now. But if you have an investment making 4%, what you keep in your pocket is still 2%. It's the same number whether you make 4 or 12. It's going to depend on what inflation really was. So understand tax consequences when you're thinking about your financial decisions. Understand inflation. All right, let me get down through a couple of things, and then I'll start opening up for questions. Pattern recognition. I have a couple brothers who really focus on this, and I love it because they're engineers and they really geek out on where the pattern's going. Well, this is a perfect chart. If you look at this blue area of the screen, you say, oh, I'm not going to buy that stock. Well, this is the S&P 500 back in March 2009. And if you look at the short-term piece of the S&P 500, you would have said, from a pattern standpoint, it doesn't make sense. It looks like it's on a downtrend, right? Like people saying, oh, it's a double bottom, all the technical analysis. The chart on the left, which is a much longer-term view of the S&P 500, is a very different-looking chart. And so, how are you making decisions based on these patterns? What frame of time are you including in looking at these patterns? And so, I think it's very important to just go through Wikipedia, which I love. Wikipedia, if you just Google behavioral finance, defines there's so many of these heuristics. And they go through a lot of them. So if you're really interested in this topic, I have a lot of white papers on it, but you can also go to Wikipedia and do some research. And some of the stories are hilarious in terms of how people think about making these accounting calls. And it's based on these simple mental fallacies. So understand your own mental heuristics. Again, another common one, client comes in, should I pay down debt? My car is financed, I don't see this today, but maybe a few years ago, 7%. Or should I buy a CD at 7%? I really don't see that right now. If you have them out there, let me know. It's the same difference, right? But is it ignoring taxes and inflation? And you have to think about, again, the bigger picture. But mental accounting, 7%, if there was no tax impact, would be 7% whether or not you pay down or make a return, right? Same difference. All right. So the other piece I'll just put in there is about comparing apples to oranges, and I do a lot of talks about this. When I start out putting together a correlation matrix and doing a risk modeling optimization on a portfolio, one of the things I'll look at, for example, is if I'm trying to insert an asset class, and let's say I'm using emerging markets. Well, emerging markets have different parameters on the screen than I would on a U.S. large cap stock. You can't use the same decisions in terms of, you know, I'm looking for a certain amount of beta or a certain amount of volatility, they're going to be more volatile. If you're looking at a mutual fund, you tend to see a higher expense ratio because they're overseas and they're dealing with, you know, smaller countries that sometimes are a little bit more difficult to get into than you would a U.S. large cap manager. So I have different screens for different sectors and for different pieces of the you know, asset classes that I would insert into a client's portfolio. So what are the things that you can do? Of course, I'm biased. I think having an objective third party who really understands how to get together a plan, how to base your risk on your plan, not on your gut. You know, what are your goals? I think that's very important. And so finding a trusted advisor, I think, is a big part of this. And again, I'm probably biased because I am that advisor, but I do feel like there's a place because we've already seen the charts. We know most people underperform the markets because of their own fear or greed or whatever is leading them to make poor choices. So don't let emotions drive your decisions. Focus on building wealth, and this is a big one that, again, in the last 5 years, I can't emphasize enough. Focus on building wealth versus preventing losses. If you're focused so much on the loss, you're going to anchor on that loss, and you're not going to make a decision. Understand your perceptions, and like I said, you know, go to Wikipedia, do some research on what is a mental heuristic. What does that mean? Understand your own biases to money. You know, are you the type of person who, when you're stressed, you go out shopping and that's your therapy? I have clients who do this. Hey, I do this. I mean, there's times I'm online at 10 o'clock at night. I'm like, why am I online shopping? I don't need anything. It's because I'm stressed. I've had a bad day. Please do this. Understand those imperfections of yourself. Forgive them. But if you don't acknowledge and accept them, you can't move on and you can't be successful. So understand what those are. And I think that goes back to looking at how you were raised with money and just understanding all the emotions you have around it. And then, again, avoid that mental accounting of making rounding errors. Think about the bat and the ball where people say it's 10 cents. It's not. It's 5 cents. So I hope that was helpful. I could talk about the markets for hours, but, you know, IEEE only gave me an hour to speak, so I'm going to open it up here to questions. And happy to answer anything I can from the audience. David, do you want to go ahead and give instructions again on how to enter a question? I know you can go to either Twitter to the hashtag WIELEAD. But I'll let David talk about just some of the ways to get in.
Thanks, Cheryl. Yeah, if everyone would like to ask Cheryl a question, you could do it through the WebEx on the chat feature. You could just enter your question and direct it towards me, David Stankiewicz, the host, or you can use the Q&A feature or tweet it using the hashtag WIELEAD. I see that some of you have already used the chat feature, so there are some questions, Cheryl. I'll just go right down in order. We have about 10 minutes left. The first question that comes through asks, Cheryl, I'm about to get married. I'd like to know how I can protect myself and plan for combining my finances with my husband's. Any advice?
Yeah. First of all, I always like to see both women and men, both genders, really have their financial house in order before getting married. It is still quoted as the #1 cause for divorce out there. So, again, this goes back to understanding a lot of your own emotions on money, coming to terms with those. Create a financial picture. You need to understand your full net worth, what you own. You need to understand what you owe. I recommend doing a credit check on your soon-to-be spouse. I always recommend both partners keep a separate checking account. And if women are planning on changing their name, I do recommend keeping a separate checking account in the female's name or the, I'm sorry, the pre-married name as well. I've been married for 14 years. I love my husband, who's an engineer. He's great. But I still have a separate checking account just in case. So I feel like that's very important. Run that credit check. And understand if you're going to combine your assets and combine your income and expenses or keep things separate. And I've seen couples do both, and it can work out successfully both ways. But have a conversation so that you are coming to terms of how you want to manage it. I always give couples permission to have different risk tolerances. Hopefully you have the same goals, ultimately speaking. But it's okay to have different approaches to money. It is very important to have an open line of communication around it.
Thanks, Cheryl. Got another great question here. This is from Gabriella Garay. She's actually an IEEE member, and she is the Women in Engineering Chair for our Honduras section. She wants to know, she wants to know what the best way to assess her tolerance for risk is. And she wants to thank you in advance for your presentation and all of your knowledge that you shared today. So if you could just address Gabriella's question about tolerance for risk.
Yeah, you're welcome. You know, it depends a little bit on how long you've been investing. When I sit down with a client, I always like to ask, you know, what did you do in 2008 when it was really rocking and rolling? You know, if you were investing back in 2000, 2001, what did you do back then? And that's going to help you understand kind of what you've done in the past. I think past performance, as you will, doesn't guarantee future results, but it's a very good indication of your behavior. If you're a more new investor, I think this is a very difficult area. We know millennials, and again, lots of studies supporting this, we know millennials are a lot more afraid of the stock market than the generation before them. You know, a lot of them were coming out of school, graduating, going into a jobless economy, and really a lot of distrust around the stock market. And among financial advisors, there's a lot of distrust, you know, hiring a financial professional to help them. So I think assessing risk for that generation is a little bit harder because they came at it at such a difficult time. And again, it's that anchoring and the recency bias that's preventing them from investing in something that has been the greatest master of wealth in all time. I think in understanding risk, you really need to understand that the stock market has less than 2% of the time been negative for 3 years in a row. So if you have it over a 3-year time frame, you can tolerate more risk. If you need money in less than 3 years, you're going to be more conservative just by definition of what your goals are. And do you look at it every day? You shouldn't be, probably, if you are. I have to look at it every day, but most people should not be looking at it daily. So I think that there's some good risk questionnaires. I'm happy to email you one, but it will go down and say things like, you know, if your stock fell 10%, what would you do? Would you leave it alone? Would you add and double down? Would you, you know, write it out? What would you do? And so going through some of those common questionnaires, and again, I can send you one. I know that there's one on Fidelity at the Morgan Stanley website, at Fidelity's website. There's lots of these websites that will have one. Good way to assess your risk. But I think it's more important to assess risk not on a gut level, but on a rational level, which is how long until you need the money and what are you building it for. Common example I would use with a client is if you're trying to save for college for your child or yourself, college is inflating much faster than that 2% inflation I talked about earlier. Your college average is going up at about 5.6% a year in the last 10 years. So if you're using, you know, double E bonds are paying 3%, you're not even keeping up with inflation of college, so you're almost forced to take a little bit more risk than you would normally. So I think it's really important to tie risk to the goal, understand what the goal is, understand what the time frame is around it, and that's going to help you take some of that emotion off the table.
Excellent. I have a question here that somebody had asked Cheryl. I'm even interested for the answer on this. This is definitely a gender-neutral question. What do I need to ask or know if I'm considering hiring a financial advisor? So I'm actually curious to hear what you have to say on this.
Yeah, I think it's really important to understand what are the criteria you're looking at when you're interviewing people. I think the CFP website is a great place to start. And again, I guess my conflict of interest is that I am a CFP holder, a Certified Financial Planner holder. But there's a list of 10 questions on the CFP website that you can arm yourself with before entering a financial advisor's office. First and foremost, I would talk to them about what kind of clients do they work with. If that doesn't fit you, maybe it's not the right advisor. All of us have different strengths, and I know I focus on a certain area of the population that maybe some other advisors would be better serving to you than I would. It's really important that that advisor is aligned with what your interests are. If they're talking about themselves at the first meeting and about portfolio performance returns and going on about that and not asking about your goals and your needs and who you are, I would say probably not the best advisor for your situation as well, because you want someone who can really customize their strategies to being about you, not about them. And then how they get paid is another big one. There's two common types of advisors. There are commission-driven advisors and there are fee-based advisors. I'm a fee-based advisor, and I work that way because I believe to serve clients, I really need to be conflict-free and to be picking investments that are in their best interest, not in mine. So for me personally, it's just ethically how I feel about the business model. I never want to be picking something that I'm going to get paid more than something else because it should be about what is best for that client. And all my clients are very unique individuals. They have different needs. Now, that's not to say that there are not some great commission-driven advisors out there that can be highly ethical. I have friends who are commission-driven and they're great advisors. But again, just understand how they're getting paid. And if they're picking investments and they're picking investments that are only their company's products, you might start really thinking about how they're getting paid even more so. So that's another one I think very, very critical. And then how do they make their buy-sell decisions? You know, because we're human too, and unfortunately, financial advisors also fall into this category of complying with mental heuristics and taking shortcuts. And so get an idea and an understanding of their own discipline and their portfolio approach, because the goal is to find someone who's more disciplined and objective than you are.
Okay, Cheryl, the questions just keep rolling in here. This is a really good one. I read an online study that showed that women tend to save slightly higher percentage of their paychecks than men, but in the end, they ultimately end up with smaller balances because of their lower earnings. Does that mean women need specially tailored financial advice? Can you elaborate on that?
Yeah, you know, it's funny. I had a conversation earlier today with a client of mine, and she has children, and she has decided to have some work-life balance, that she's going to go from a 40-hour work week to a 30-hour work week. And I don't know if any of you have colleagues who do this or are doing this yourself, but I know in her case, because I talk to her frequently and I know how hard she works, she is definitely doing the same amount of work in 30 hours as most of her counterparts in 40 hours. And yet she's been passed up for a raise for the last 5 years because she is quote-unquote part-time. And yet her counterparts have gotten raises almost every single year. So I told her last week, I said, you know, you need to advocate for what you deserve to earn. And if you don't, it's not just about you, but it's about all women advocating for what they deserve. And if you are doing the same amount of work, that's one issue. But if you're doing quality work and working less and less time, and your boss and you have agreed to that arrangement, you should still be getting recognized and getting bonuses, just like, you know, your full-time counterparts and some of your male counterparts. So she went to her boss and she said, you know what, I really like this job, but I feel that I'm being undervalued and underrepresented, and I had a great review this last time and I didn't get a raise, and it's been 5 years since I've gotten a raise, and I'm going to leave because I don't feel like this company values part-time workers, and yet you encourage women to have a work-life balance. And her boss came back and gave her a 6.5% raise this morning. So I was so proud of her, first of all, for advocating for her rights to be paid what she should be getting paid. So I think part of the problem is just us standing up and saying, hey, this is what I'm worth, and advocating for that. I have seen similar studies that women in general do save more. And you know, for me, it comes down to a combination of factors. What are you spending? What do you need to spend during retirement? You know, what is inflation? But it's really important to be saving enough and investing aggressively enough, because we also have found that women tend to be a little bit more conservative in their investments than some of their male counterparts are on average. So I think part of it is also just making sure you're taking smart risks, not too much risk, but smart risks and enough risks to make the portfolio grow as well. So that could be part of the issue in the outcome at the end as well. 1 or 2% a year can make a huge difference compounding for 20, 30 years. It's a great question.
Thanks, Cheryl. And we're going a little, Cheryl, do you have a couple more minutes? We're getting a lot of questions here. Can we go a couple minutes past the hour?
Yeah, I'm fine. The market is closed, so I'm good.
Okay, great. Next question comes from Tamara. My name is Tamara Cohen. I'm a graduate student in the biomedical engineering field at Marquette University. For those of us with limited income, Cheryl, is there a percentage of income you would suggest that we invest? Thank you so much in advance.
Oh, Tamara, I'm so proud of you for wanting to save. I started investing when I was in college, and let me tell you, my parents had 11 kids. They did not give me a dime for college. I was on my own. And I started investing when I took my first finance class, and I got so excited about it. And I started with, you know, I was working as a waitress, and so I started just investing my paycheck because they don't pay us very much as a waitress. And I think I was making $2.13 an hour, something ridiculous. So I lived on my tips and I invested all of my paycheck completely because it was so small anyways. But $50 a month, $100 a month, that can go a long way. And I did that all through school. And when I finished school, I had enough to pay off all of my student loans and still a little bit left over because I was investing the entire time by a small amount each month. So again, the power of compounding returns is enormous. And if I could do anything, it'd be to help everybody start investing younger because time is your biggest asset when it comes to investing. My rule of thumb is if you want to be able to retire, to save at least 30% of what you're making, because what we see as a general rule is that people save 30%, spend 30%, the rest goes to taxes. And if you're saving a similar amount to what you're spending, then you're going to have enough to support you for 30, 40 years. But while you're a student and potentially on a more of a restricted budget, I would say go through your budget and decide what you can give up. I call this the Starbucks equation. Conflict of interest, I own Starbucks stock, okay, so there's a reason why. And I love Starbucks. But, you know, if you think about your latte that's $4.85, and you do that maybe 3 days a week instead of 7 days a week, or 2 days a week instead of 7 days a week, cutting out small things and figuring out a way to create some savings can make a big difference in, again, how much you have at the end. And so figure out what are the needs versus wants, your negotiable items versus the I have to have items, and find a way to save even if you're on limited resources. I think it's so important no matter what. My kids are 11, 9, and 4, and I make them, every time they get a gift from their grandparents, save part of it, even if it's just a couple of dollars, just to get them in the habit of saving and understand that compounding impact.
Okay, Cheryl, this question has a caveat. The intro says, Cheryl, this might sound like reverse sexism, but if you're a woman, should you be working with a female financial advisor? Go ahead with that. Good luck.
You know, it is what it is. You need to find, it's not reverse sexism. You need to work with somebody who you can trust and who understands your needs. And if you feel that person is a woman and you feel you're going to be able to talk about more things openly with women than men, then yes, I do think you should hire a woman. I already said that our returns are on average better, and that's according to Warren Buffett, not me. He's a man. But, you know, I do hear from a lot of my female clients, and I have, by the way, more single female clients than single male clients. I have a lot of couples and a lot of partners as well. But as a general rule, than most of my male counterparts. And I think that is because I do tend to get a lot of women who are very successful and very strong executives, and they want someone who's got a strong personality like I do. But I also get a lot of widows and recent divorcees, and they want someone who they can cry a little bit with, and they're just more comfortable in that setting with a woman than they are in a man. I've also been told by many of them that they had a male financial advisor, and he talked down to them, and that's why they switched to me versus staying with that guy, if you will. But trust me, I know some fabulous male financial advisors out there, so it's not to say that there can't be or you can't have a great relationship. But there are potentially reasons why you may, in your own personal situation, want a woman. And I think it's okay to have those reasons.
Okay, Cheryl, and the audience out there, unfortunately, we've reached the end of today's session, so I just wanted to, I wanted to personally thank Cheryl Young for taking the time out of her day today to present to us. It was very educational, super informative. The questions were just flying in, so everybody was super engaged. If you missed a portion of the session or you just want to, again, watch it again, be on the lookout for this and all of the virtual tracks in the Women in Engineering ILC virtual conference available on demand on YouTube. You could check the schedule over the next 3 days on the Women in Engineering International Leadership Conference website. It's IEEE-IE-ILC.org. And again, me and Cheryl both want to thank the IEEE Women in Engineering Committee and Conference for giving both of us the opportunity to bring today's session to you. Cheryl, thank you again. It was a pleasure. And everybody out there today who participated in our audience, thank you so much. Have a great day.
Thanks, David, and thanks to IEEE for sponsoring this. It was a pleasure.
Take care, everybody.